Okay, hello and welcome to the webinar Project Pipeline Index 2026. What's next for North America's top mining projects? My name's Sam Williams. I will be moderating today. I'm editor of Mining IQ. We are a research division of Aspermont, which is publisher of several mining titles, including Mining Journal and miningnews.net. Today I'll be talking about our Project Pipeline Index report, which presents our pick of 50 of the best mining projects worldwide, and hearing from some leading executives from 4 companies with North American projects in that top 50, so with projects among the best in the world. So first off, I'm delighted to introduce an excellent panel of speakers today. So joining us today, we have Sam Lee, President and CEO of Northisle Copper and Gold with the North Island project. We have David Cates, President and CEO of Denison Mines, which is beginning construction at the Phoenix in situ recovery uranium asset. Shawn Campbell, Chief Financial Officer at Dakota Gold, will be outlining progress at the Richmond Hill gold asset. And last but not least, Elmer Stewart, President and CEO of Copper Fox Metals, whose Van Dyke asset ranked among our top copper projects. So thank you all for joining me today. So this is the plan for the next 45 or 50 minutes or so. I'll kick off with an introduction to the Project Pipeline Index and some key North American focused findings, followed by our 4 project presentations and Q&As, and a group Q&A at the end, which will focus on permitting and regulations. So just very briefly, a little bit about Mining IQ. We were established in 2017, as mentioned, as a research division of Aspermont, as well as the Project Pipeline Index. Our research reports include World Risk Insights, which assesses mining investment risks across 120 jurisdictions globally. We also have reports looking at ESG performance, investor sentiment, and leadership insights. So the Project Pipeline Index is our attempt to identify the best mining projects globally for acquisitions or investments, which is obviously quite a daunting task for mining companies or for investors, given that there are hundreds or even thousands of projects out there and they fall under the ownership of hundreds or perhaps thousands of companies. So the QR code on the screen takes you to the report page where you can buy or download the report, which is free for our premium subscribers. There's also a free preview available for everybody. So I'll repeat that QR code in the next couple of slides and at the end of the webinar. The 2026 edition is now out and features full page profiles of 50 of our top pick projects across major commodity groups, plus a detailed analysis of the full database, which underpins our selection process. So this is just a slide about how we do it, how we evaluate projects. As you can see, we focus on projects with publicly available studies. We don't have a lot of time to go through in depth through the project evaluation process today, but the full methodology is available using that QR code with the free preview. So yeah, as mentioned, we focused on projects with publicly available economic studies ranging from the PEA or scoping level to full feasibility study, gathering 50 or more data points when new studies are released. And we use these to compare projects across 13 indicators and 6 categories, which you see outlined in the diagram. So just want to mention really that we've been working to build a comprehensive database of study stage projects for evaluation, and the number of projects assessed has risen every year, and we reached 656 this year, and that excludes projects that have started production. So we've also added new information this year, including a description of next steps for each project, estimated first production dates where given, and more in-depth data on mineral resources and byproducts. So the database is available for subscription, so please contact me, sam.williams@aspermont.com, if you'd like a free demo of that. So moving on to some of the key findings, here are some details of our full database of the 656 live projects I mentioned as of May this year. So this shows that the total combined capex of those projects was $335 billion US dollars, averaging $513 million per project. Total combined MPV was 560 billion, with an average IRR of 37.2 and a median average IRR of 28%. So as you can see from the donut charts on the right, nearly half are precious metals projects, with battery minerals and base metals also well represented. Nearly half of our projects are also at the earliest PEA or scoping study stages, which shows that there's a significant proportion of the global investment opportunity here lies in earlier stage assets. So this map shows where the total combined project capex is concentrated, and as you can see, North America is dominant, and that's partly why we've chosen to focus on North America today. So out of that $335 billion total capex, about 93 billion is for projects in Canada, so that's more than a quarter in Canada alone, with the US second at 64 billion. So combined, that's nearly half of that global total capex figure is for Canadian and US projects. So looking again at that capex distribution, but focusing in on 2025, obviously our most recent full year. The studies released in 2025, North America remained the key focus, with Canada and the US both seeing increases in new project capex compared to 2024. Interesting though, last year, the US overtook Canada as the top country by combined project capex, and this is a trend we will be monitoring closely in 2026. And as you can see from the graph, the figures for Australia, Chile, and Mexico, third, fourth, and fifth in the rankings were much smaller. So within North America, I just wanted to highlight a few really important kind of project hotspots that we have in our database. So in Canada, in the rows in red, as you can see, British Columbia was the jurisdiction hosting projects with the largest combined annual potential new gold production at close to 3.8 million ounces per year. That's nearly 12% of the total across all our global database of projects. BC and Arizona were also among the jurisdictions with the biggest concentrations of potential copper production, after Argentina, which is obviously an entire country rather than a state or province. For lithium carbonate, Nevada was dominant, accounting for nearly 40% of global new potential production in the projects. And that concentration was even more marked for uranium, with Saskatchewan assets accounting for nearly 60% of global potential new output in our database. So I think it would have been nice to have a drum roll here, but I'm just unveiling now our 6 highest scoring projects of 2026, which, as you can see, these are a mix of lithium, gold, and silver assets. All of them are in the Americas, and 4 of the 6 are either in Canada or the US. So North America was obviously dominant in the top 6, and also in the top 50. So 23 of our 50 top projects were in the US or Canada. And as you can see from the map, there was a fairly wide distribution of gold projects and some notable clusters of top scoring projects. For example, copper assets in Arizona, including Van Dyke, uranium assets in Saskatchewan, including Phoenix, and lithium in Nevada and Quebec. So finally, I just wanted to draw attention to the North America findings of our World Risk Insights report. There's no time to go into details about the report, but you can access it or a free preview again using this QR code on the screen. But essentially, our 2025 report, which came out in February, shows that Canada and the US, as well as being the main focus of our project capex, were also the lowest risk countries or regions, providing the most favorable environments for mineral investment globally. So one of the few drawbacks is perhaps traditionally seen as slower permitting processes in the region, which governments are obviously taking steps to improve, and that's something we'll discuss in the Q&A at the end. So with that said, I'd like to stop sharing, and I will pass over to the first of our project presentations. So I'd like to hand over to Sam Lee for his presentation on North Island, which ranked among our top scoring copper gold projects this year. So, Sam, over to you.
Thanks very much, Sam. That's actually very fascinating. My background, I ran the CIBC's global mining practices for 20 years, and what I saw during that time period was a flip-flop back and forth from activities from Canada moving down to the Americas, Latin America, Chile, Peru, Africa, back in the 90s and 2000s. And certainly, it's very encouraging to see some of that activity looking poised to come back to the Americas as well for all the virtues that you just explained. So that's exactly where we are. We are a big copper gold porphyry, and the strategy effectively is unlocking copper value through gold. I will be making forward-looking statements throughout this presentation. One of the really unique features of this project is that it is not only a value proposition, as we have a PEA that we released last year as we de-risk and re-rate through to the feasibility study in quick order. We also are a growth opportunity. We've got over a 50-kilometer porphyry district that we're spending a tremendous amount of time and money and effort to unveil what we believe is a multi-generational opportunity. We own 100% of this porphyry district. And of course, nothing happens without a social license. We believe that community up is the way to sanction any project, certainly in British Columbia or in Canada. But that's something that we've enabled and affected through our very strong relationships with our First Nation partners and community moving forward. So last year we announced our PEA at very conservative pricing scenarios. This is interesting because as part of your stats, you talk about an IRR of, average of 30%. Well, we have a 30% IRR. The big difference is with our project that this is a 30-year life of mine, right? So when you actually compare that 29-30% after-tax IRR to a 30-year project, you will be very hard pressed to find a project anywhere in the world with these economics. And the reason behind that is because this is a copper and gold project, right? Gold, we believe, is the critical currency of the world. And of course, copper is the electrification critical metal that the world needs to obviously make our initiatives and strategies happen, including electrification, decarbonization. This is a $2 billion after-tax NPV at $4.20 copper prices and $21.50 gold prices, which again is second to none when you consider that it only has a 1.9-year payback for effectively a 29-year mine. So at prices that were spot last year in February, that was $2,900 US gold and $4.67 copper prices. This is a $5 billion after-tax NPV project with a 45% after-tax IRR. So tremendously levered to commodity prices. And that's something we've been sanctioned to move forward as quickly as possible. We raised about $155 million to progress this project on an expedited basis based on that. In terms of the growth opportunity, it is, again, the exploration across our 50-kilometer district. We own 100% of this. We're effectively bookended by the BHP historical Island Copper Mine, which was in production for 24 years, and 4 deposits that we have discovered over the course of the project history life. And so this year we are spending $10 million on an initial exploration program that is looking to obviously increase our resources, focus on the more well understood areas in the Northern Quarter where all the deposits currently sit. And then, of course, be bold and effectively branch out around a district scale exploration program that's going to be unveiled very shortly in the second half of this year. So just to give you a glimpse of where we are on Vancouver Island, which has become one of the most strategically important aspects in Canadian politics now because of the fact that we are literally on the west coast of Canada. So no pipelines, no infrastructure that needs to be built across this opportunity. In fact, all of this area north of Campbell River was built in the 60s and 70s for the BHP Island Copper Mine. So that's roads, powers, ports, The town of Port Hardy was about a 200 person town back in the 60s. It's now about 3,000 person town. That was all built for the Island Copper Mine. And so that's effectively where we live today. And that's something that we are going to take a very full advantage of as it relates to the infrastructure. This is effectively where the BHP Island Copper Mine sits on the south east of our project tenements. And we own effectively 100% of that 50-kilometer district all the way to the north. That's what the mine looks like today. That's arguably one of the closest deep sea water ports from continental America to Asia. We also have access to one of the largest wind farms in British Columbia. This when Cape Scott Wind Farm produces approximately 100 megawatts of excess power capacity, just about a kilometer north of our project. In British Columbia, this is a very important initiative, right? You need to have this point of intersection around project infrastructure, strong infrastructure, the ability to access global partners, and of course, the mandate around critical metals. And so as a result, we've seen projects similar to ours that have been expedited around permits over the course of the last couple of years. British Columbia is very much open for business. We've staffed our team like a blue chip company. We've got over 200 years of people that have worked at BHP, at Newmont, at CIBC, where I worked, effectively finding, building, developing, operating, and then, of course, funding these types of major projects in the world. And so that's something that we are now very well poised and set to execute an aspirational, aggressive, but achievable strategy. Our leadership at the board level, second to none, led by Alex Davidson, who everyone knows in our industry. He's a mining Hall of Famer and is really setting the new version of our strategy, not only focusing on the development, expedited development of our project, but also looking at this 50-kilometer district scale exploration opportunity. And so this year, the $155 million that we just raised through the public markets, which shows that the market has now sanctioned our project, which is critical to developing something quickly. Then next steps and catalysts for this year are going to be the resource estimate that we're looking to come out the end of Q2, beginning of Q3, metallurgical test programming, and then, of course, the integrated pre-feasibility study by the end of Q4, early Q1 of next year. So that's on the project development side. We are now currently drilling a very aggressive exploration program, as I described, near-term expansion of resources, which we just came out with a very positive result last week around Red Dog. We are continuing that activity with currently two drills specifically focused on exploration. And so those results around the growth aspect of our strategy will be coming out in Q2 and Q3 of this year. And then finally, of course, the district scale exploration strategy around accessing the full 50-kilometer district will be initiated in H2 of this year. So a lot of activity for Northisle coming up. We're very excited about what the future holds, and we thank you for your attention.
Okay, thank you very much for your presentation, Sam. We have a couple of minutes for a question. So you've got the PFS work progressing. How's that going? And pending positive results, how quickly do you plan to move ahead with a feasibility study, and how quickly can you foresee that concluding?
Yeah, great question. So everything's on track. We've effectively completed infill drilling. We released those results, those final results a couple of weeks ago. That's where we saw not only very positive grades across the pit shells that we are looking to obviously increase in terms of the grade profile within those pit shells, within the block model. But we also saw an extension of high grade. This is over kind of 1% copper equivalent past the pit shell over 135 meters. So that's going to be included in our resource estimate that is set to come out in most likely early Q3. The idea of expanding our pit shell is obviously the decision we made strategically to do so after seeing these, over 1% copper equivalent grades beyond the pit shell. That will be followed by metallurgical test work, as I mentioned, and that will obviously set us in favor to complete the pre-feasibility study by the end of Q4, early Q1. So the interesting thing about the $155 million that we just raised was actually to contract the project timeline. Right now in British Columbia, and in Canada, there is a very aggressive movement around reducing the regulatory time period by about half. The time. And so I'm sure we'll talk about this a little bit more later. But we need to be prepared in order to activate that if and when that does happen. And so by being prepared, we actually have to advance feasibility study work to ensure that we can do so. So whilst we are going to announce and present the pre-feasibility study in the time frame I just spoke about, it is effectively going to be at feasibility study level details because that is what's going to help us be part of the discussion around project contraction. In the meantime, we are advancing very rapidly our discussions with our First Nation partners, for which we have consensus agreements with all three of them, which are Quatsino, Quaguth, and the Tlaxcala First Nation bands, such that when we are in that position to effectively look to a contracted permitting period, they will be literally side by side with us, understanding everything we've done to progress the project and it not being a surprise to them when that happens. So we've got the funding to do it, which I think is absolutely critical. And now we've got the First Nation governments that are currently, as we speak, understanding the project intimately through our JICs and JTCs. These are joint implementation committees that make sure that when we do enter into the proposed contracted time frame, everyone is aware of what the project is when we submit it.
Okay, that's brilliant. Thanks a lot for your interesting comments on that. Look forward to some of these forthcoming milestones. Um, so next up, I'd like to hand over to David Cates, CEO of Denison Mines, whose Phoenix in situ recovery project was one of the highest scoring uranium projects globally. So a really high scoring project. So yeah, over to you, David.
Sam, thank you very much. And look, we absolutely appreciate the recognition from Mining Journal Intelligence. Our project has been one of the top projects for the last 3 years with our Phoenix ISR project, and it has absolutely supported our outreach to investors and institutional and retail that are interested or growing an interest in this sector. So thank you very much for that. What you can see on the screen here is the fact that we have entered into the first stages of construction with our flagship Phoenix ISR, or in situ recovery uranium mine. The project received its final federal approval in Canada for construction to commence in February of this year, which made it the first new uranium mine to be approved for construction in over 20 years. Our company had significantly advanced detailed design engineering and construction planning, as well as financing. And as a result, we were able to make final investment decision approximately a week after receiving that final federal approval for construction. That was in February, and shortly thereafter in March, we mobilized to site and began site preparation and early works construction, which continues today, with an objective to be into full-scale construction by the end of this quarter. And then that would start the clock on our approximately 2-year construction timeline, with expected first production in the second half of 2028. That would make Phoenix likely the only new large-scale, or one of the only new large-scale uranium mining projects to enter the market globally before the 2030s. Company is TSX and NYSE listed. Denison has a market cap just over $4 billion right now. And of course, I will be making some forward-looking statements in this presentation. And the best source of information about our projects are our technical reports, which are available on our website. Quickly, just on the company, and then we'll dig into Phoenix. We do have a portfolio of mining development and exploration assets in northern Saskatchewan in the prolific Athabasca Basin region, which is home to the largest and highest grade uranium mines in the world. Our flagship project is Wheeler River. It does have two mining projects within it. One is the Phoenix ISR project, which I mentioned is now entered into that construction phase. And the second is the Griffin project, which is conceived as an underground mine, which we expect to be able to advance using the cash flows from the successful execution of Phoenix. We are actively mining right now at our McLean Lake joint venture with Orano, which is a global leader in the nuclear fuel cycle owned by the French government. They operate the McLean joint venture, which has a large uranium mill, which processes ore from the nearby Cigar Lake mine operated by Cameco. But also we are now back in mining at McLean Lake using the Sabre mining method. Also, we are invested in other development assets, again, with Orano at the Midwest project, which is being evaluated both for Sabre mining and ISR mining, and a portfolio of exploration interests throughout the region. One of our main objectives in the company is growth, and we are aggressive right now on the exploration portfolio that we work, I'll call it domestically through Denison, but also through our exploration partners and our Team Denison approach, which includes companies like COSA Resources, Sky Harbor Resources, and Foremost Clean Energy. Our company is unique in that while Phoenix is our flagship asset, we have multiple development assets, and those development assets are situated in the bottom quartile of the global cost curve for uranium mining projects. Phoenix has the potential to compete with the lowest cost projects in the world, which are generally in situ recovery in Kazakhstan. Griffin, also very competitive, being able to utilize existing infrastructure in the region and the infrastructure that will come to the Wheeler River property for Phoenix. Midwest, situated considered as an ISR mine here, also has the potential to be one of the lowest cost assets in the world. In terms of where we're at with Phoenix, and then we'll close with a recap of the incredible economics we have from the project. As I mentioned, we have started site preparation. A very critical milestone for us was right at the beginning of our execution schedule, and that is site clearing. We are operating in northern Saskatchewan, and we are subject to very rigorous environmental control or regulations. And so being able to clear the site in the winter months, shortly after getting that final federal approval, was a major milestone for us. It would mitigate the effect of the migratory bird season. We are operating in a remote region, northern Saskatchewan. If we had nesting birds in the wrong places, it certainly could have impacted our ability to execute on our civil and earthworks programs, which in northern Saskatchewan are the sorts of things that you want to be doing during the summer months. And where we have a limited window for prime construction operations. So on this visual, you can see that we've cleared the entire site. This is as of the end of April, and we've been able to transition into civil and earthworks. What also you can see on this slide is the infrastructure that's already been brought to the site. That transmission line highlighted in purple, that was built by Sask Power. We are connected to the provincial power grid, even though we are in a remote district. And that's owing to the infrastructure that's supplying the existing mines in the region. Power is available right now at our site. It's our job to carry out our construction plan to be able to tap into that power and electrify our site as soon as possible. Couple of quick other visuals. We are accessing the site via air. Our airstrip is one of our critical first-year scopes so that we can access via fixed wing. But right now we're using large helicopter transports as if we were operating offshore oil and gas type operation. But the region is 10 to 12 hours away by road from Saskatoon, and we can cut that travel down significantly by using large helicopter transport, moving 18 people at a time, using large helicopter, and that trip is a 2 to 3 hour trip. certainly making the construction workers more happy, and increasing our rates of retention for those workers, but also operating efficiently. We're able to pay our teams to work on the site rather than sit on a bus when we use the helicopter. So that helipad that's shown on that slide was also a really important part of early works. And you can see from the other two visuals at the top that we have started that civil earthworks exercise, which is critical for us to execute in the summer months. The project itself and how we've gotten to this point, even though the uranium markets have been very challenging over the last decade, really is about the project and how we've navigated and conceived developing this project. Phoenix will be the first in situ recovery uranium mine in Canada. ISR is a very common mining method globally, as you will have seen from that cost curve earlier. But the combination of exceptional high-grade uranium deposits from Saskatchewan with a low-cost mining method has been very powerful here. Our grades at Phoenix are very high, would be one of the highest grade uranium deposits and projects globally, averaging over 11%. But most importantly, that high-grade core area where we have 56.3 million pounds that average 46%. So you can imagine that that's mostly where our ISR mining is focused, exceptionally high grade. And to bring in together a low-cost mining method, that's how we've generated rock bottom type operating costs, even all-in costs. Those all-in costs of under $19 US include initial capital. It's a fully loaded all-in cost. Initial capital, sustaining capital, OPEX, and closure under $20 US per pound. Our base case IRR is based on uranium prices that ranged from $65 to $70 US per pound. Today we have a spot price that is at $85 US per pound. And we have a contract price, fixed price that is testing $100 US per pound. So 73% base case post-tax IRR is even better in today's market. And the 2.6 to 1 post-tax NPV to initial capital cost ratio even better in today's market. And importantly, because it's ISR, we're doing this with a relatively low capex, upfront capex price tag in the range of $600 to $700 million. Compared to a greenfield underground mine development in the region, which would be more in the range of $2 to $3 billion. Happy to leave it there, Sam, and go from there.
Yeah, thank you. We've got perhaps 30 seconds a minute for questions. I just had one question on the construction. I saw there was some issues with recent flooding on Saskatchewan. Has that had any impact on your construction progress?
Yeah, well, the flooding has certainly been a complication for operations in the north. To be clear, none of the flooding was really occurring in the Athabasca Basin region directly affecting the operations, but it was affecting the road network to get to northern Saskatchewan. We did see Cameco suspend operations at the Key Lake MacArthur operation. We were able to continue our operations without disruption, but not without extra effort. The focus was on using alternate road routes versus the roads that had actually been taken out of service. One of the bridges on one of the routes was actually down, but we were able to work through the alternate route and adjust our logistics supplies. Having our helicopter for personnel transport was really critical to keep people moving and supplies when roads were not passable. But generally, we managed without major disruption to continue operations. The province of Saskatchewan was exceptional in terms of responding to this truly unprecedented flooding with daily road repairs, new culvert installations to keep supplies and that lifeline of the road operating as best as possible. Conditions today are much more ordinary for this type of year, and most of the operations have normalized in the region.
That's brilliant. Thanks a lot for clarifying that, David. Moving on now, we have Shawn Campbell, Chief Financial Officer at Dakota Gold, whose Richmond Hill Gold Project ranked 5th out of all 656 of our projects. So, Shawn, over to you.
Thank you for that. So I've got our presentation up on the screen. During the presentation, I will be making forward-looking statements, and you can see the disclaimer here. Again, the full disclosures are available on our website and in our technical reports. And so excited to be here today We are advancing rapidly with the Richmond Hill Gold Project, which came out with our initial study last year and made us eligible for a report like this. And very happy that we ranked number 5 globally across all the different projects. Dakota Gold has the Richmond Hill Gold Project located in a safe jurisdiction in South Dakota in the United States. The company and the project itself has moved quickly with a resource last year on the project and then an economic study mid-year. We're looking to put out a pre-feasibility study later this year and then followed up with a feasibility study the following year, and then construction in 28 and then production in 29. And I think a number of the themes of the overall report that you're generating on these projects dovetails with our project. So the renaissance of mining in the United States and the general support is something that we very much appreciate, both in terms of a permitting and capital availability. The project is located on private land, which we'll hit on why that's important from a permitting and from a timeline perspective. And then we were also able to raise $75 million earlier this year, which put us in a great position with $107 million in the treasury, which allows us to do not just the project advancement, but look for long lead time items that help de-risk the mine construction. So here's a map of where the project is located in South Dakota in the historic Homestake district. And so when we were first attracted to this area, it was because the Homestake mine had produced 40 million ounces of gold over 125 or 40 million ounces of gold over 125 years. And we were able to secure the land adjacent and to the north of that. We also picked up all the land available for staking, and then the Richmond Hill Gold Project, which is on private land that you see there in green. It's located only 2 kilometers away from the Court mine, Wharf, which has been operating for 40 years. And what's great about the Richmond Hill Gold Project is that we are going to be able to look at the Wharf mine, which has a 3-stage crush, simple heap leach, and it's almost a brownfield expansion because of the similarities and consistencies of the project. So this group has performed some great analysis on benchmarking our project, and you can see here some of the highlights. But in our measured and indicated plan, we had an NPV of 1.6 billion and an IRR after tax of 55%. And that's at a conservative gold price of 23.50, not reflecting the current spot prices. But in addition, we had a 17-year mine life with 153,000 ounces per year of production. What I'm excited about as we advance this project is looking at that long mine life and the additional 100 million tons of inferred material and what we can do to expand that production and condense that overall mine life. I'd also say as a junior, we're excited that we've got a portfolio of projects because of the mineral acres we've got, where we've got a high-grade underground opportunity in that JB Gold Zone discovery, where we hit an average of 11 grams over 4 meters. And excited that once we are in production at Richmond Hill, we can take that cash flow and invest in a portfolio of opportunities in the district. So there's a lot of numbers on this slide related to our initial assessment with cash flow. So I'll just maybe point out a couple. One is that base case gold price, which a year ago was 23.50. In the bottom right hand, you can see what happens at current gold prices. So at spot, you're looking at a $3 to $4 billion project. And I know one of the metrics the study looked at when ranking projects was NPV to CapEx. So when we released our study, we had a little bit greater than 4 to 1 NPV to CapEx. But at current spot prices, that gets to 10 to 1 ratio, which I think a lot of people in the industry struggle to understand why some projects are perpetually stuck in that feasibility stage, whereas some advance. And I think it's metrics like that that show investors and the capital providers that these are projects that should be funded and should be advanced. And we're happy that that helped us secure that $75 million financing earlier this year in order to advance this project. So when we looked at our opportunity and the overall land package in this district, we kept in mind that permitting is always going to be a key challenge for a company. And so given the Richmond Hill project could be placed entirely on private land, and that's what you see with this green outline, we made the decision that while we have Forest Service land or federal lands surrounding our project, if we could keep the entire footprint within private land, it meant we only had state and county permitting for our key permits. And so while this project looks condensed within that green line, it's deliberately being built as big as it can within that green outline of private land. The overall construction of this project, I say that nothing in mining is easy, but relatively speaking, this is a easy project. It's a simple 3-stage crush with a Merrill-Crowe plant at the end and a heap leach operation. Here in the initial assessment, we had 6 phases of pits where we started and finished each pit. Excited that when we look at this PFS study, we'll talk about the trade-off study, that in conjunction with some of the drill results show you the sub-phasing that potentially brings some grade forward. And then when we look at the mine plan and the reclamation, South Dakota does permit based on a net acres of disturbance. And so our plan contemplates backfilling in order to keep that net disturbance as low as possible throughout the mine life. But what I point out is that compared to a greenfield project, we've got the Wharf mine operating 2 kilometers away. We can follow their path in terms of the mining style, in types of the truck usage, in terms of the 3-stage crush with a 1/2 inch, but we also get to follow their pathway in terms of permitting and working with the state and the county regulators. So almost more of a brownfield expansion project from a risk standpoint. We've advanced this project quite quickly, and our initial assessment had a resource with a 2024 cutoff for drilling. So in the second half of this year, when we put out our PFS study, we will have all the 25 drilling, so 250 holes. We'll have all of our 26 drilling, another 112 holes. So excited that we get to put in 30% more drill holes into our PFS resource coming out in the second half of this year. Now, when we designed this program for 2026, we really just looked at, well, we had the deposit open in most directions. Well, we had 100 million tons of inferred material. We really wanted to preserve and reduce dilution. So we only focused on areas where we envisioned mining in the first 5 to 7 years in terms of both expansion and infill. And you can see the results were very strong, with well above the average grade being returned in intercepts over 25 and 30 meters. So opportunity in this PFS resource to expand the resource, to convert the inferred, but then given the mineralization is near surface in many areas with no strip, you can look at sub-phasing and bringing that grade forward. If you look at the initial assessment with cash flow, we didn't try to optimize that mine plan. What we did is come up with a base case where there was opportunities. And so in our PFS, we'll look at sub-phasing, and can we take any of those pockets of higher grade material that you can see in this cross section forward? Because right now the average grade in our first 3 years is actually less than the life of mine grade. So what can we do to bring that grade forward and positively impact the PFS in the second half of this year? The PFS is well underway, but for us, there's really 2 studies that we think are going to move the needle for it. One is that mine sequencing, and I showed you the intercepts in the drilling that get added to the database and the opportunity for sub-phasing and bringing that grade forward. But the other obvious lever that we have is when we were doing this economic study, the Eye with Cash Flow, a little 12 months ago, we were very aware of the market's perception of a small market cap junior advancing a large CapEx project. And so we deliberately managed the project to get it as small as we could. And that meant a jaw crusher at the front end and the related infrastructure and that 30,000 ton a day throughput. In the current market, and with that 17-year mine life, plus the additional drilling we've done, we're going to be looking at putting a gyratory crusher in the front end. And what that does is it gives the circuit, the crushing circuit, the flexibility to go from anywhere from 30, 35,000 tons a day, all the way up to 60,000 tons a day. Now, for us, what will actually probably limit it is going to be the stacking plan and the ability to leach the material coming out from the crusher. But even if you end up at the midpoint, between those two goalposts, you're looking at a 50% increase in throughput contemplated in this study. Just a map of the overall project area. Again, this is where you want to be building a mine. We have a public access road coming to site. We have a power line at site. We have the water rights. We're a 15-minute drive from our head office. The cost when you are building a project and you have that proximity to your labor, to your workforce, you can have a flatbed truck come and drop off a piece of equipment. Our initial assessment with cash flow had 0 off-site construction costs. We don't have bridges to build to be able to advance this project. So very excited. We've got the local labor force. At the same time, this is not a pristine location. It is an existing mine site that has that footprint. So happy that we're building the project where we are. Also, you can see here that JB Gold Zone, those high-grade underground opportunities less than 2 kilometers away. So once we are in cash flow from the Richmond Hill project, because we're managing that dilution, we have the ability to ramp down from our private land into the heart of these high-grade zones, which gives you that opportunity to reinvest in the overall portfolio once you're in production. So just to recap on that timeline, last year we had a resource, we had an initial assessment with cash flow. We will have the pre-feasibility study in the second half of this year, followed by the feasibility study in 27. Our permitting process really started as soon as we came out with that initial assessment with cash flow. And because we're on private land, we were able to take that map of the project and sit down with the state regulators that have a mandate to engage with you. We had proposed 25 water wells for ground and surface monitoring. We sat down and through a meeting decided we would move one and add one. So we have 26 water wells. What's great about that is we finished drilling them last November. When we come to submit our permit, both sides have already agreed the exact location, depth, data that is coming from that water monitoring program. And it really de-risks the permitting process, being able to engage with the groups that are ultimately going to issue those permits so early. So from the start of the baseline data collection, notice of intent will be later this year, and then an ultimate permit in 2028. So 2 years from the notice of intent, but really a 3-year plus program that we're already well underway. On the engineering and EPCM side, one of the factors that your study has highlighted is that there are many projects in this gold price environment that have become economic, and we will all be competing for capital, for people, for critical components to build our assets. So I'm really excited that this week we actually just put down our deposit to secure our substation. A power substation is being used in all these AI data centers and any large construction project around the globe. We see right now about a 24-month timeline for critical path items. However, as companies raise the capital and advance their project, that could extend to 3 years. So by us having a large treasury of over $100 million, we're able to identify those critical paths and de-risk the construction timeline and get to production in 2029. I just like showing this slide because this shows you the Homestake mine in our district that produced 40 million ounces of gold over 125 years. Very excited about a project on strike where the old mine had made a discovery called the North Drift discovery, but our JB Gold Zone with 47 intercepts of 11 grams over 4 meters, that will be what's next after we get Richmond Hill Gold into production. So just really excited that as we look at that NAV of the project, or as we look at the EV per ounce increasing, we've issued our shares to be fully funded till construction ready, till shovel ready, which means we've got 140 million shares outstanding and potentially could have that same number as we get that construction financing. Analyst coverage has doubled in the last 6 months with the excitement around this high quality project. So with that, I'll maybe hand it back over to you, Sam, for any questions.
Yeah, thank you, Shawn. Just a few seconds for a kind of very, very brief question, if that's okay. Obviously, you've got PFS coming up. You're planning very rapid progress at the project. How well financed is the company to achieve all that?
Yeah, so with $100 million in the treasury and having done that financing, it allows us to de-risk that construction timeline. So as I mentioned, we've secured our power substation, which was the #1 critical path item when you look at that timeline for construction. But we have the ability and flexibility to take whether it's up to $30 million through this period of doing the advanced detailed engineering and be ready so that when we do have that permit in hand, we can execute on a 12-month construction period.
That's great. Thank you for that, Shawn. And next up, we have Elmer Stewart, who is CEO of Copper Fox Metals, and he's going to be talking to you about the company's Van Dyke project, which ranked among our top copper projects globally. So, Elmer, over to you.
Thanks, Sam, for inviting us to this presentation. I think it's the first time we've been on one, and it's interesting listening to the other presentations earlier. Today, I'm going to talk about our Van Dyke project, and it's part of Copper Fox's portfolio of projects in British Columbia and Arizona. We're focused on copper primarily, but we also have a considerable amount of other critical metals like molybdenum, gold, and silver in our projects. The opening slide here highlights the Van Dyke project, but it also shows Mineral Mountain and Sombrero Butte, which are located in Arizona, and Shaft Creek, which is a joint venture with Teck Resources, and the Eagle Head project, which is in northern British Columbia. Our forward-looking statements, I'd urge our reviewers to pay attention to this because we do make some forward-looking statements. Next slide. Copper Fox has always had a strong ESG policy, and it's essentially based on early engagement, preservation of wildlife, protection of the environment, and transparency, which means you get out early and let everybody know what you're doing. Next slide. The Van Dyke project is located in the historic mining gold district. It's got past production. It's got the advanced stage Van Dyke project, which is an ISCR project, and it's advancing through the development stage. It's also got district potential because of the recent discovery by BHP of the Ocelot discovery, which is a deep one under the Gila conglomerate. At the bottom of the page, you'll see a little bit of a cross-section where the historic mining was. And on the right-hand side, you'll see why the Van Dyke deposit has not been previously mined. It's hidden under, buried under a few hundred meters of Gila conglomerate. Next slide. The project, we've done quite a bit of work on it, and our objective really is to restart the production from the historic Van Dyke mine. And on the right-hand side, you'll see a number of criteria listed. And when you look at those, these are really the criteria I think that companies are looking for when they're advancing projects through the PEA stage, to the PFS stage, and to the FS stage. And I'm happy to report that the Van Dyke project fills all these criteria. Next slide. A little bit of the project history. It was originally founded in 1916. It was subject to underground mining, higher grades at around about 5% copper. And the late 1970s and mid 1980s, a couple of companies, Occidental for one and COSI, did some in situ copper recovery test pilot programs. They were successful in doing that. We acquired the project in 2013. And since then, we did a considerable amount of work to take it to its current status. Next slide. And in situ copper recovery is relatively new for copper. I know it's been used a lot in uranium, and interesting to see it's being used in northern Saskatchewan. But the advantages are many compared to conventional open pit mining. You don't have open pits, you don't have to worry about storage weights, you don't have the large footprints, and it really does consume a lot less energy, water, and a lot lower emissions of GHG gases. Well, certainly a smaller footprint, and it's a lot less social disturbance. So we see the advantages of the way we're tackling the Van Dyke project is we're going to go underground to access it, and we believe that is going to help us avoid the aquifers in the area because Arizona is very, I wouldn't say it's touchy about water, but it's very important in Arizona. And that really will, it's out of sight, it's out of mind. So we believe it's probably the best way to go. Next slide. one thing is important to understand about copper and ISCR deposits. They're not all oxidized deposits are amenable to in situ copper recovery. We've listed here the favorable criteria that you need for a project which you would be looking for if you were going to advance it. And I'm happy to report that the Van Dyke project has all this criteria in place already. Next slide. This slide shows you the historical production on the top left-hand side of the face. You can see where the open pits were. You can see the location of the Van Dyke deposit itself. The key thing is you look at a previous slide, it's on the east side of the Miami Fault, so it's down throwing. But the key thing here is the exploration target. We see that the deposit is open to the southwest, and that's where the real upside is on the project, because it gives you the potential, assuming positive results from drilling, that you could be able to substantially increase the size of the resource, which obviously, hopefully down the road would dictate a longer mine life. Next slide. One of the important things in situ copper recovery is clearly understanding the geological model. And that also includes the structural model because of the way it could impact groundwater flow. This is the current model we have. It's a very simple deposit. Gila conglomerate sitting on top, leach cap, which in the red is basically the outline of the economic zone of interest. And as you can see, it's fairly flat lying, so it's fairly amenable to vertical drilling techniques. Next slide. A little bit of a picture of the core. The green and the blue are the green is the malachite, which is a secondary copper mineral. Azurite the same way, and it just shows you how it occurs throughout the cores. Next slide. This was the resource estimate done in 2020. We're doing an updated mineral resource estimate in 2026, and that's part of the preliminary economic assessment, which we're currently underway doing. It shows you, again, the location, how the geometry of the deposit looks like, and the criteria. About 1.2 billion pounds of recoverable copper, and we basically put our resources out. Mostly we're dealing with the soluble portion of the copper component, and that's the acid soluble and the cyanide soluble copper. So it's about 1.2 billion pounds in total based on the 2020 resource estimate. So when we get the new estimate out, we'll see what it looks like at that point in time. Next slide. Proposed underground development, and this is the proposal we had in the 2020 PEA. Now, all aspects of the PEA are undergoing a thorough reassessment. So when we complete the new PEA, the underground access is probably not going to look like what you see in the slide. I don't have one just yet for the new one, but we're working on all the critical aspects. And we're anticipating that the PEA at the end of, when we complete it, hopefully toward mid-July, the end of July, assuming we get all the contractors on site, that we're going to be able to put out a more updated presentation on what the whole project would look like. Next slide. We also did a considerable amount of metallurgical tests. This is PRT tests, and we leached it for about 120 days. And as you can see in the pictures, after 120 days of leaching here, there's still a considerable amount of secondary copper minerals still in the samples. Now, normally you leach these panels for about 1 year, so we anticipate the results from leaching would be significantly better than what we got from the PRT tests, and we did like what we seen in the PRT tests. Next slide. We also did some mineral solubility, mineralogical test work, and we got some excellent results of that as well. But the key thing there is the test work indicated the low potential to generate carbon dioxide, and also a very low chance of precipitating gypsum during the leaching process. Those two parameters can be very detrimental to copper production down the road. And so the fact that our test work indicated we have low potential, that we think that removes a couple of the operating issues that we would be having to address down the road. Next slide. A little bit about the economics of the project. On the left-hand side, you'll see some parameters from an operating standpoint. You'll see some parameters from the economic standpoint between 2015 and 2020. But I want to draw your attention to the slide on the right-hand side. Essentially, it shows you the sensitivity of what a 25 cent per pound increase in copper prices does to the EBITDA, the free cash flow after tax, and then the after tax NPV. So if you look at, we did a base case at 315, which was the consensus price at the time. It gives you a pretty good idea how sensitive this project is to copper prices. Next slide. A little bit of the social economic benefit. This project is located in the historic mining district of Miami Globe. And right now, a lot of the activity down in that area is starting to wind down. There are 3 projects still going on. One is Capstone, and Freeport McMoran, and KGHM. If this project goes through to production, it's got based on the previous PEA we did, it's a 17-year mine life with exploration potential to expand the resource. Hopefully, could push it out beyond 21. It creates a significant amount of jobs in the Miami Globe area, which is important down there. A lot of the operating expenses would be spent or incurred inside the Miami Globe district. We quantified that. And then, of course, you got the state and federal taxes as well that accrue from the project. So next slide. Here's some of the activities we've completed since we acquired the property. And the current activities, we're focusing primarily on the hydrology because we feel that the hydrology is very important to be able to predict future copper production. So we're focusing on that. We're doing a lot of work. We're modeling. We're hoping to come up with a predictive model. We hope to get that in the PEA. We're not sure whether it'll be done at the time. But the idea, we're updating a PEA, and the reason why we're doing that is because the last PEA was done in 2020. This PEA is 2026. We did a lot of work between 2021 and 2025, all of which is going to be incorporated in. And what we wanted to do here is get a very clear technical assessment where the project is at, because the focus is to transition the project into the PFS stage. So when we get the PEA done, we'll obviously have an assessment, and we'll see where we're at that time. Next slide. And that ends the presentation on the Van Dyke project.
Okay, thank you very much, Elmer. Just a few seconds for kind of a quick question. What excites you most on the exploration side at Van Dyke?
Well, I think it's the exploration potential to the southwest. Clearly, we've identified a very strong target there. We've got lots of strong geological criteria to support our interpretation. And if you look at the size we outlined, you could potentially you could double the size of your resource there.
Perfect. Great. Many thanks for your brief answer. So we are running a little bit late for time on this. I'd like to just move quickly on to the Q&A, and first of all, looking at permitting. So as I mentioned earlier, one common concern or complaint in Canada and the US in recent years, at least, has been that permitting speeds are slower than in some other countries. Obviously, efforts are underway to address this, but what's your view on the permitting timelines where you're located? And Sam Lee, if we can go back to you first. I know Northisle was recently selected for inclusion in the British Columbia Critical Minerals Office. What is that, and what would it mean for permitting speeds in British Columbia?
Sure. Maybe I could provide a little bit of context. As I said, I ran various functions at CIBC, and one of them was the Latin American cross-border M&A functions within the mining space. And what I alluded to before was the reality. Back in the 60s and 70s, BC was the foremost leader in mining. We were the copper producers for the world. It was the epicenter. Nation building projects, infrastructure, all that rhetoric that we're hearing today existed back in the 60s and 70s in British Columbia. And then it became this environment where permits, as you said, were becoming slower and slower to receive. And there was this mass migration away from Canada and some of the tier 1 jurisdictions, including the US and Australia, to South America, to Africa, because the permitting contraction was much more appealing. And of course, geologically, there was a lot of support for going there. What has happened over the last probably 20 years, but more recently over the last 10, is that it's now becoming harder and harder and harder and longer and longer and longer to permit these projects in in Latin America and in Africa. And to the extreme extent, what you're also seeing is that some of these projects are getting expropriated from the holders of the owners of these projects because the social license isn't there. And so the biggest difference between the past cycles versus this cycle is that, of course, we're all looking for exploration success, but what's going to limit the industry around being able to permit projects is actually the social license. And that's what didn't really exist last cycle. Now, this is the extreme focus of the larger incumbents. We just saw one of the largest, if not the largest mining company in the world, extract themselves from Africa. We're seeing a re-diversification of these companies from Latin America to the tier one countries, including Canada, the US, and Australia. And so, whilst I would say that the permitting timelines being part of the CMO, it's part of this nation building exercise in Canada, whereby there is an attempt to contract project timelines within the context of First Nations consultation consensus, and of course, existing infrastructure. Projects that have access to existing infrastructure aren't don't need that incremental major capital expenditure spent by the government. These are things that are becoming very important within Canada to reestablish their importance and dominance across the world scale. And so, the jury's still out as to what that looks like in terms of the contraction of the regulatory period. And we understand that that is going to come out reasonably soon over the next couple of quarters in terms of what that plan looks like in Canada. But what I can say is that the rest of the world, on a relative basis, especially these jurisdictions that have been more dominant in the last 30, 40 years, like Chile and Peru and, Latin American countries, their project timeline, permitting timelines have actually expanded. And so I'd like to actually think that British Columbia, yes, we suffered for many decades around lackadaisical timelines, but I'd like to say it's because of, for good reason, around establishing that social license, for which now we are 30 years ahead of the rest of the world in terms of figuring out how to do it.
Great. Okay. Yeah. Thanks a lot for that, Sam. Perhaps we could move over to David. Obviously, as you mentioned, I think Denison was one of the first large uranium projects to secure approval in Canada for some time, 20 years, I think. How would you describe that permitting process in general and specifically for uranium?
Yeah, well, it was not a short process, Sam. Canada has very rigorous environmental controls and review processes, and by being a uranium mining project, we also are subject to federal regulation by the Canadian Nuclear Safety Commission. This is the same federal regulator that would regulate the nuclear power plants in the country. So they certainly approach the approval of projects with great rigor. Look, we wish it would be faster. There's no doubt about that. But at the same time, we've made the most of it. So to achieve the criteria necessary to get those permits, we were, roughly 90% through total engineering of our project, which at the end of the day does assist us in executing the project. Many mining projects will start construction with far less engineering in place. And importantly, in our industry, our customers are nuclear power utilities globally, many of which are public or government-owned utilities, and they care a great deal about where the uranium comes from. So the fact that we have an excellent federal regulator with a globally strong global reputation, it gives our customers great trust that when they buy Canadian-produced uranium, they're acquiring uranium that's been produced sustainably and responsibly. And that's to our advantage. We certainly see that customers globally want to buy their uranium from Canada, and it gives us the ability to negotiate differently than if we were producing uranium in a country that was really just a commodity they're acquiring. Here, many of the customers care deeply about that, and our regulatory environment has that value that it brings to it as well.
Lovely. Thank you, David. Moving back to Elmer, you're obviously at an earlier stage for Van Dyke, but do you have any kind of concerns or thoughts in brief about permitting in the US and Arizona in particular?
I think it pretty much echoes what you see that the guys have already said, what we've got here in Canada. You have pretty much the same issues. You got federal issues, you got state issues, depending what grant you're working on. And the issue is simply this. I mean, the people who work in the regulatory agencies, they have guidelines which they have to abide by. And, the thing is, we fully support, what they're doing there. But one thing I would recommend they do, set specific timelines in which to respond to either the proponent or the proponent respond to the regulator. And I think that would hurry it up. I don't think we need to change it. I just think that, we need to set a little bit more rigorous timelines on when responses have to be provided. And that's the same issues we're running into here in Canada as well.
Great. Okay. Thank you. And Shawn, what about South Dakota? Any thoughts on permitting?
So we've seen a lot of change in the United States over the last 3-4 years in terms of the pathway forward from permitting. At one point, we saw federal legislation that was meant to introduce critical mine legislation that might have excluded gold. And had that legislation advanced, it might have been very difficult to advance a permit for a non-critical mineral. When you look at our project specifically, we have silver as a byproduct. Silver has been listed as a critical mineral by the USGS. It's used in solar panels and different manufacturing. And so for us to be able to say that we're going to produce a critical mineral in the United States, and in a form, because of the doré bar that will come out that can be refined into a finished product, it's a very strong selling point from a social license and from a government perspective. But the other decision we made was that by staying on our private land, we could maintain our permitting with the county and the state. So we have seen some traction with the Fast 41 at the federal level that has maybe been a bit of a game changer for some of our peers that are on federal land. But for us, we get to follow a process that I think just makes a lot more sense when you look at how you're permitting a project. We get to engage early with the regulators. We got to sit down with them and agree on where these water monitoring wells were. We got their feedback. So when we come in with the permit, it's as expected and as designed. And then on your presentation, you showed the sort of revitalization and growth of mining projects in the United States. I think that people are recognizing the level of investment. We've spent $250 million to date with an expected CapEx right now of $400 million in our study. That's $650 million in a state the size of South Dakota, where that's a very meaningful investment. And then you also have tax regimes where in the state of South Dakota, you have no corporate income tax, but you have a 10% severance tax on gold. So we're one of the few industries that cut a check directly to the state government. So we appreciate the working relationship that we've got and the level of engagement and the fact that we're dealing with people that are deciding on the future of a permit for a mine in their state and with their neighbors.
That's brilliant. Thanks for that, Shawn. We are running a little bit over time. I'm going to really condense this final question, which I had to you. Obviously, as I mentioned, our World Risk Report highlighted that Canada and the US are our lowest risk jurisdictions globally. They're some of the most favourable places to invest as a mining company. Just wondered if you could each just very briefly give your state or province a score out of 5, a star rating out of 5, and just highlight one thing that if you had a magic wand that you would change. So perhaps if we could kick off with Elmer and Arizona.
I'd give Arizona about a 4. The process can be long depending what you have to do. But I don't really have any suggestions how they could change it. I think the new administration in the States has made it abundantly clear they want things on timelines.
Okay. Thank you. And if we go back to Shawn, South Dakota.
Yeah, so I'll go with a 4. And what I would say is that while there is a considerable amount of mining expertise in the state because of the Homestake mine that operated for 125 years, It did close down in the early 2000s. So some of the same state regulators that permitted an open pit expansion in the town of Lead are still there and working, but it has been 20 years since a new mine came online for precious metals. So we are working through and we're bringing the regulators to our project, and they've got experience with Wharf. But we are going through a process for a new mine that hasn't happened for a number of years.
Great, thank you. And over to you, David, Saskatchewan.
Look, Sam, great question. Denison has a long history, 70 years in the industry. We've operated in the United States and multiple states, Africa, and multiple jurisdictions in Africa and Mongolia. We choose to do business in northern Saskatchewan in Canada because we think it's a 5 out of 5. The provincial government in Saskatchewan is incredibly supportive of sustainable resource development. They're building what they call Strong Sustainable Saskatchewan. They understand that resource development provides economic benefit for the people of Saskatchewan, and that provides the quality of life that they're looking for. And the government is personal. They, you know, the government, they know about your project, and they're not bureaucratic. They are there. Even the Ministry of Environment is there to make sure that you can achieve your objectives while protecting the environment. We couldn't ask for a better place to do business.
David, did I forget, or did you not mention a star rating?
5 out of 5.
5 out of 5. Great. And finally, Sam Lee, back to you. British Columbia, what's your view?
Thanks. I'll break it down into the components that actually inform that star rating. So in terms of infrastructure, it's 5 out of 5, right? As I said, BC was one of the most prolific mining countries in the world back in the 60s and 70s. In terms of talent and labor, which is a huge issue in our industry, it's a 5 out of 5, 100%. In terms of political will, well, we have a center-left government right now that has included us in the critical metals office and looking to expedite projects that have First Nations consent, infrastructure, and critical metals exposure. So political will, I would say 5 out of 5.
Great, thank you very much, Sam. We are now significantly over time. I'd like to thank all our guests for joining me today, and thank you for your valuable insights. Also, I'd like to thank everybody for joining us in the webinar today. If anyone does have any comments or questions, please do reach out and email me at sam.williams@aspermont.com. That's the end of the webinar. Thank you very much and have a good day.